How's it going, everyone? So, I just want to welcome everyone back. And for those who are new to the channel, I focus on dividend-based stocks and I use the Trading212 platform to grow my portfolio. So, for anyone that would like to sign up and invest in their own account, feel free to use the link in the description below. You will receive a free stock worth up to £100 if you invest £30 or more into your portfolio. So with that said, the main focus of this video today is to understand what type of investor you are. And throughout this video, I'm going to highlight what type of investor I am, but I'm going to list out a range of different investment styles that you may or may not be. So the first type of investment style that I want to talk about is what's known as an active investor. So an active investor is generally an individual that likes to buy and sell stocks very quickly. The goal there is to maximize profits in a short amount of time. In addition to being an active investor, you can have what's called an active management portfolio. And so I've actually spoken about this a little bit more in depth using the Nutmeg platform. So I'll supply a video for you to look back on should you want to, and you can always come back to this video. So with an active management portfolio, what happens is you have a full-time staff of financial researchers which will actively manage the portfolio on your behalf. And the goal there is to try to beat the market and so provide higher returns for investors. Now, due to the additional costs involved, such as paying for the expertise of such staff, there's generally a cost, whether it's monthly or yearly, added to maintain the portfolio. And so there are some investors out there, myself included, that doubt the ability of active managers to actually outperform the standard market gains. So that transitions us nicely into the next type of investment style, which is known as a passive investor. So for those who do not believe that financial experts can create a greater than normal return and equally do not want to pay the higher costs associated with the ongoing research, you would be considered a passive investor. So what generally happens is a passive investor will invest in the likes of index funds or ETFs. So on the Trading212 platform, we can see some examples of an ETF. Now, if I type in the keyword Vanguard, we can see a whole list of ETFs. And so if we take the most well-known, the S&P 500, and we just open up the graph. So here we have an ETF that tracks the top 500 US-based stocks, and we can see back in early 2018, we're around the price, if I take this value here, of just under $35. Now, if we look at the gain currently, we're around the $47 mark, so an increase of $10, which is a percentage increase of over 30%. So in the space of 2 years, this index has increased by 30%. And so simply investing your money into the S&P 500 can be a really great way of investing passively. So as you might realize, there's many different ways of investing, and you're free to use the Trading212 platform to invest in any way you like to. Now in the future, I will talk about a different way to invest in the Vanguard-based stocks. But for now, anyone that wishes to invest in an index fund or an ETF, they are free to do so should they find the ticker symbol within the Trading212 platform. Now in addition, research has actually shown that over the long run, passive investment can outperform the likes of active investment. So we've spoken about whether you are an active or a passive investor, but the next two types of investment styles we're going to compare is what's known as a growth or value investor. So a growth-based investor will look at fast-growing firms. And so one example of this would be Tesla. So I'll just bring that on the screen at the moment. And so we can see, for instance, that in early May of 2019, the price was around $177, and we're currently at a price of over $400. And so although Tesla itself is intrinsically variable, there are extremely large gains to be had. So an investor that cares about growth-based companies, every 3 months there is what's known as an earning call, and there will be statements about how high the growth rate has become, how high the return has been on the equity, whether there's been high profit margins, and generally the company should have low to no dividends. And the idea behind is that the company is considered to be a market leader, And so any profits made can be reinvested back into the company, and the company can achieve what's known as economies of scale. There's very little to no competition in the way, and the company is very much a market leader. So referring back to Tesla, and so one could argue that Tesla is a leader in terms of electronic-based vehicles, but in the long run, that percentage will decrease with more competition. But nonetheless, a small percentage of the pie can still enable a company to be a leader in that given industry. Okay, so contrasting with a growth-based investor, we have what's known as a value style investor. So when focusing on value-based investing, the primary goal is to focus on stable companies which have a high dividend yield. And so for those that have been following my channel, they'll be aware that I focus primarily and solely on dividend-based stocks. And so let's take a common example of a value-based stock. So I've just typed Intel on the screen and let's have a look at the graph. So looking at the graph, in May of 2019, we had a price point of the $43 mark, where we are now currently at the $59 mark. So we have yet another example of a stock that has increased by 30% in the space of 7 or so months. In addition, Intel is what's known as a dividend-based stock, and so every 3 months, a percentage of the company's overall profits are allocated to shareholders in the form of dividends. So it's just additional money that is given to shareholders that is not reinvested into the company. So personally, I would consider myself as a value style investor, but at the same time, I would happily invest in the likes of growth-based companies, because if you see a good company out there, then you are free to invest in any type of company. So with the last two investment styles, a growth and value style investor, you can actually merge the two together. Now, on my account, within the Trading 212 account, I stick primarily on value-based stocks and those that pretty much pay a good dividend yield. If you want to buy a bunch of growth-based stocks within the Trading 212 platform, you are free to do so. Equally, if you want to use a separate account to just focus primarily on growth-based stocks, you're free to do that as well. There's a whole range of different investment styles, and it's not a one-size-fits-all. So that leads us on to the final comparison, which is between that of a small versus large cap company. So there's some investors out there that feel as though small cap companies should be able to deliver much higher returns because they have a greater opportunity for growth in the future and are also a lot more agile because they can pivot at any moment in time. So a small cap company is defined as less than 2 billion in terms of market capitalization. Now, when it comes to small cap companies, there is a disadvantage in that the company has not been around for a long period of time, and so it's very hard to tell whether the company will be existing in the future. Now, contrasting to a small cap company, we have what's referred to as a large cap company. So on the screen, I have an example of a large cap company, which is Alphabet, Google. And so generally speaking, a market capitalization for a large cap company is in the $10 billion and above. And so if we actually want to know what the actual market capitalization is, we can run a quick search on Google. And here we can see we have the market capitalization worth over 932 billion. And generally speaking, when we have a price of greater than $500 or above, we can more or less tell that we are working with a large cap company. So individuals that follow large cap companies feel more security given that the company has been operating for a long period of time. The only downside is that there's less room for growth in the future, and so the potential gains are not as high compared with that of small cap companies. So whether you invest in small or large cap companies, honestly, it doesn't really matter too much. You can invest in one or the other or both. So hopefully this video has been helpful to highlight the different range in investment styles and for you to personally decide which type of investor you are, and you are free to experiment and apply a range of different investment styles to suit your needs. With that, I want to thank everyone who has been following along with the channel so far, and I plan to provide more exciting content for you all in the future. So with that said, I will see you in the next one.